Borrowing during the pandemic enabled businesses to meet their liquidity needs, including paying wages. The deferral of debt repayments helped households that experienced a temporary loss of income to pay their bills. In these ways, debt helped prevent economic scarring, which meant that economies were able to bounce back strongly once health restrictions were eased. Borrowing during the pandemic pushed the combined debt of households and businesses to an all-time high in 2020 of around 170% of world GDP. High debt increases the vulnerability of borrowers to adverse shocks, including the higher interest rates that we're now seeing. This can result in repayment stress that weakens the financial system and reduces lending to the real economy. In our report on private sector debt and financial stability, we highlight three aspects that require close attention. The first is to examine the capacity of risky borrowers to continue servicing their debts. The second is to gauge the vulnerabilities stemming from booming residential property markets. And the third is assessing whether risks might be underpriced due to perceptions about the prospects for exceptional policy support in the future, such as occurred before the Great Financial Crisis, when implicit guarantees contributed to the too big to fail problem. In economies where debt-related risks are mounting, borrower-focused macroprudential tools, such as limits on debt service to income ratios, can help stem the build-up of vulnerabilities. In economies where debt-related risks are deemed high, it's important that financial institutions' capital buffers remain sufficient to absorb potential losses so that banks can continue to be a source of economic resilience in the future. Finally, policymakers can address policy-related distortions that might exacerbate debt vulnerabilities. Structural policies such as tax and bankruptcy regimes are important here. So too is managing expectations about future policy support that might lead to the underpricing of risk by lenders in the future.